Welcome to Sravz technical series. In today's session, we'll go to the time series analysis and how it is done in Python, and then we'll discuss the use cases of the time series analysis. First, the demo. In the Sravz system analytics platform, you can go to the time series link by clicking on the time series shortcut here, time series. So it brings up the time series screen. Here, Sravz supports up to 58,000, close to 59,000 asset classes. So it supports stocks, mutual funds, etc. So for today's demo, we'll pick the most well-known stocks, for example, Accenture, etc. So for example, if we look at the Adobe stock, click on the stock, it takes a while for the time series to generate in the backend, so around 10 seconds. So once you wait for around 10 to 15 seconds, this tab should display and it shows the time series for the time series analysis for Adobe Stock. So today we'll go through these plots and try to understand how if time series is beneficial to us to make any decisions on the investments. And of course, this is for research purpose only. This doesn't signify any investment. This doesn't imply any investment ideas. So I'll switch to the documentation page. So this is the Sravz documentation page, which is all linked in the, will be provided in the YouTube video. So once you go to analytics page and then click on the time series page, it has all the information here. So the source code is already uploaded to the GitHub. So there's a time series notebook and I have a bunch of references here based off of which I created this video. So today we'll go through this analysis and try to understand if time series is useful in predicting stock prices or if time series is just a random walk or the time series is stationary. If it is stationary, we can make some prediction, but if it is a random walk or a white noise, we need to do further analysis. So I'll open the notebook. So this is the notebook. I'll quickly run the whole notebook once. So we first upload the price data. The price data is static file in a JSON format in the data dictionary. So I'm going to do analysis of gold, futures price of gold in this Jupyter notebook. So I printed the head and the tail of the price series. So gold settled at 1964 on July 14th. That was yesterday, day before yesterday. And then the time series. So I'll run the time series analysis. It's in a separate module called timeseries.py in the source directory. So it takes around 20 seconds to display. So there are a bunch of warnings here which we will ignore for now. Later on we'll try to understand what are these deprecation warnings and try to fix it. Now the time series analysis is generated and this is the tier sheet or multiple graphs that are plotted on a single page using matplotlib. Now we'll go through each of these plots and try to understand how the time series analysis is done. I'll open the documentation page again. So first we plot the adjusted close price versus date, which is this plot, adjusted price versus date, and we see that the plot is upward trending. The price has constantly kept going up. It started around $250 in 1985 and today it's around 1964. So there's definitely an upward trend, and there's of course some seasonality here which doesn't show in this plot, but if you look at an annual basis, there's always the price goes up usually during the October season and up to March because of some seasonal buying by various countries. But recently we have political events going on, so that's why the seasonality doesn't show. The price has been stable for almost 2 years now. Since 2020, it has been stable in this range. So now we see an upward trend, and we want to remove this trend. So to do that, to remove the trend so that the plot is centered around zero, that is mean reverting back to zero, we do a first difference, pt minus pt minus pt1 of the price to remove the trend, the upwards or downwards trend, and the plot is centered around zero, which is shown here. And then, but there is still an issue with the plot. The variance today is way too high compared to the variance in the past. Ideally, the variance was constant all the time, but the plot doesn't show that. So we'll first, so we have to smoothen out the variance. So to do that, we'll go through the variance again in these plots. So here, if you see here, the plot is an exponential plot. It is going from 250 to 1750. To smoothen out the plot on a linear scale, we take a natural log of the adjusted close price and plot it against it, which we did here. So the natural log price versus date converts the exponential curve to a linear curve. And then to show the variance, we took a 30-day moving average variance in the plot here. And then when we see the original variance, the variance today is way too high compared to the variance in the past. So to smoothen out the variance so that we can see the variance in the past, we take a natural log of moving average moving variance and then plot it with date. And if you see here, the variance is shown in a uniform way. So we can see the variance in the past too. So that's the benefit of taking a natural log of any series. It will smoothen out, it will magnify the variance in the past if the plot is upward trending, or if the plot is a exponential plot. Now to smoothen out the price, so this is what we discussed. So then we take a natural log of the adjusted close price first difference. So we take ln, so we do ln pt minus ln pt1. Here we did pt1 pt minus today's price minus yesterday's price. In this plot, we take a natural log of today's price minus natural log of yesterday's price. So once we do that, the plot is enhanced throughout the time. We can see the variance in the past and today. It's a better representation of the variance, and the time series is stationary. So by taking a natural log and then taking a difference like today's price minus yesterday's price, we have made the series stationary. So now once the series is stationary, we can do further time series analysis. But now we have to think if this is even beneficial, is it even good to do any prediction based on this time series after it has been made stationary. So to do that, we do something called partial autocorrelation test. So autocorrelation is done using this formula. We take a lag. In our case, we took up to 40 lags, 0 to 40 lags, 0 to 40 lags. And the autocorrelation with a lag is done by taking each lag at a time. So for example, if it is lag 1, which is equal to PT minus PT1, today's price minus yesterday's price, then K would become 1. So you would have total, if there are 10 observations, your total would be 9 observations because you have taken, so PT, my indicator I starts from 1. So assume you're starting from 10 days back and you're moving forward. So that way you can understand the plot better. So your 10th day in the past is 1. then your ninth day in the past is 2. So if you index from the past to present, then this formula makes sense. So you take the correlation this way, and then you plot the correlation like this using stat model Python module. I'll show that in a bit. So once we plot up to 40 lakhs, so we have two plots here. One is autocorrelation, and this is partial autocorrelation. Partial autocorrelation will plot the variance that is not explained by the first plot. So that's what it means. Not already explained by the previous lower order lags. So once we plot this, we can visually see, and we have set our significant correlation at greater than 0.2. So if anything is above 0.2 in this plot, then we can say that a price on a particular day is correlated to a price on some other day. So for example, if this is above 2 on say on 30th day, this dot was, if it was above 0.2, and then this 10th dot is also above 0.2, then you could say that every 10th day in that observation, the plot is correlated with 0th observation. So 0 and 10th are correlated because there is a significant correlation on above 0.2 on 10th day or 30th day. So once you see that correlation, then you can make any trading decisions every 10th or 30th day. Like we said, the price is moving in a particular correlated way, so we can make those trades on 10th and 30th day. But unfortunately, we don't see anything of that sort in gold prices. Gold hasn't seen any correlation. So we plotted for complete history, which is from 1985 to 2025. Then for 10 days, still don't see any correlation. Then last 5 years, we did see some negative correlation here, some little bit of correlation there on 27th day, but it's not that significant. Didn't go above 0.2 in 5 days. On in 2 years, same issue. We didn't see any significant correlation. In a yearly plot, we saw some correlation, like every 5th day, it went to 0.2. So maybe if we do a short-term trades on a monthly basis or daily basis, based on this 5th day, maybe we can make some trading investments. For example, on 25th day, there was a negative correlation, which was not explained by this. So yeah, based on a yearly plot, we see some correlation, but we still have to do further analysis to see if we can make any investment decisions based on this 1-year plot. Then there are some other models called ARMA, autoregressive moving average, and autoregressive integrated moving average techniques. We will discuss that at a later point in our next session. So the code base is uploaded to GitHub. I'll quickly go over the Python code base in the VS Code. So we use stats model to get imported the autocorrelation and partial autocorrelation functions. And then we used matplotlib. We created a plot with the 18 sections in it, 18 vertical sections. Then we subdivided the vertical sections into subplots. So we did all that and then we plotted them. So this is self-explanatory, where it's all based on pandas. So we did the first difference using taking the difference like this. And we did the natural log using natural log, rolling natural log over 30-day natural log. Similarly, we did autocorrelation and partial autocorrelation using these functions from stats model. So the rest of the code is self-explanatory. If you have any questions, please let me know in the YouTube channel or in the documents page. I'll respond accordingly. So with that, I'll close today's session. Please go over the time series page at Sravz.com by clicking on the time series link here, and you could experiment with various assets. Maybe there are some assets which show some kind of time series correlation. And as I mentioned, it takes around 10 to 15 minutes to show the plot, so please wait for a bit. So thank you for watching. Please let me know if you have any further questions.